Well, greetings and salutations, test takers. This is Series 7 Guru coming to you from my off-grid studio, getting our kicks on historic Route 66 with something I wasn't sure I should put on the channel. This is the Series 7 Alpha practice test. I use this in weekend classes for men and women who are joining the securities industry to get their attention from, just graduated Northwestern or Harvard or Stanford. You get the idea. Uh, Very bright men and women to get their attention. And, the Hippocratic oath that we follow at guruexamprep.com is first do no harm. And so that's why I've contemplated whether we should put up an alpha practice test on the channel. Unlike the actual exam, which gives you a balance of easy and difficult questions, alpha practice tests only give you the most difficult questions and concepts you could expect to encounter on the actual exam. So you shouldn't be alarmed if you don't score well. And if you are getting your psyche damaged as you work your way through this practice test, I would say, screw it. Go back to lots of good diagnostic exams that we have available on the channel that give you a good correlation to the actual test. Okay, with that disclosure, let's see if you can take the alpha practice test or whether the alpha practice test will take you. Okay, here we go. Hit pause, answer, hit play. See how you do. It's 5 experimental questions here. Maybe I'll give you a break and tell you which ones are experimental, or you can ask me in the comments which ones are experimental. All right, performance opportunity number one. A client bought an industrial revenue bond. The bonds were called because of condemnation. This would be covered under which of the following clauses in the bond indenture? That would be covered under the catastrophe call. The catastrophe call would be found in that indenture. That indenture is a contract between the issuer and the trustee for the benefit of the bondholders. As it relates to a revenue bond, the other thing that would be very important in that trust indenture is the flow of funds and which fund has priority. Under a net revenue pledge, the operations and maintenance fund would have priority. All right, number two. Your client has $500,000 worth of securities, an additional $100,000 in cash. If the firm were to close due to net capital inadequacies, SIPC would assure the client, and you should definitely know it's a maximum of $500,000. And so the answer is A. We go securities first, so that's 500,000. You become a general creditor for the amount that exceeds that. 3, the total takedown. Veritest will know the components of the spread. The components of the spread. And the total takedown is not an individual component of the spread, right? The total takedown is 2 components, the concession and the additional takedown. So the answer to that, let me get out my highlighter here, is the selling concession and the additional takedown. Those 2 components are called the total takedown. I do have a whole video on underwriting municipal securities. The component that would be missing here, because there's 3, concession, additional takedown are 2. Those 2 make the total takedown would be the management fee. The management fee is typically the smallest individual component of the spread, and the selling concession is typically the largest individual component to the spread. And if you only get the selling concession to your firm, it is not a member of the syndicate and not a risk for unsold securities. Number 4, disintermediation. Don't you love that term? I always think of Lord John Maynard Keynes saying that money is a giant floating crap game. It's always going from one place to another. So when the money supply tightens, the Fed raises interest rates. Does money move? Is it money in motion? The answer is yes. When they relax the reserve requirements on banks, the money supply goes up. 3, money market funds rates are higher than typical savings accounts rates. Yes, that's the reason money market could be so attractive or potentially attractive. The discount rate is decreased. It's 1 and 3, and I wouldn't worry about Fed movements and things like that as it relates to your Series 7. Yeah, I'd be more worried about economics and the money supply and all that stuff on an SIE exam. and on a 65 exam. A client acquires a newly issued 1,000 par, 5% convertible corporate bond, convertible to common at the 40. So as I've always said, the minute you get a conversion price, you gotta say bastards. I don't need the conversion price, I need the conversion ratio. So I stop immediately and I figure out that that's a conversion ratio of 25 shares. The common stock increases 20% from initial parity due to a hopeful earnings projection. What is the parity price of the bond after the rise in the common stock? Wow. Well, they're saying it moved from par. And so the answer here, I thought we are going to be asked about parity of the stock, and they're asking what is parity of the bond. So it's equal to 25 shares of the stock, right? Initial 20%. So that would be $1,200, 1,000 times 120. Welcome to an alpha exam, right? Bond trust indentures are required for which of the following? Well, remember, munis and treasury is exempt. And so, we typically in munis, revenue bonds do have trust indentures, but they're not required because remember, munis and treasuries are what we call exempt securities. They're exempt from the regulatory framework. And so the answer is A, right? So we may have them in munis, but they're not required, right? Not required. 7, which of the following would be considered in the fundamental analysis of a security? So to say you're a fundamentalist does not mean you're a member of the religious right. To say you're a fundamentalist means you like to look at the balance sheet and try and get a margin of safety. You should definitely know that support and resistance level is technical analysis. Trading volumes, technical analysis. Liquidity ratios, the current ratio, the quick ratio, the acid test ratio, certainly. And then historical earnings trends. Yeah, is there earnings momentum, so to speak? And so the answer is B. I like that. You should be able to distinguish between fundamental and technical analysis on your exam. Let me clean up the screen here for us. A municipal securities broker or dealer who receives an advisory fee from the issuer and then subsequently underwrites the issuer's A-rated bonds, according to the MSRB, has to notify purchasers in writing. B. I don't particularly like this question because we're not allowed to switch our roles from being, an advisor to being an underwriter. So this particular question, I probably should clean up a little bit, but given this answer set, the answer is B. Anytime should we say, should something be disclosed? The answer is yes. The more likely test question is that we would terminate our financial advisory role. And then in the MSRP prohibits us from switching those roles. So given the answer set for 10B, I would call that experimental because I probably should fix that question. I don't like that question. It doesn't speak to me any longer. All right, use the following information to answer the next 4 questions. Okay, so it says in the opinion of the bond counsel, the interest is exempt. So there's our kind of telling us that our legal opinion is in place. It's a new issue, so that's a primary transaction. Marina Del Rey, California. So these are revenue bonds, series, meaning different issuing dates, and serial, right, meaning different maturity dates. They're going to be registered. Wells Fargo is principal payable. That's called the appropriate instrumentality. Who cares? The interest will pay check mailed to the registered owner of the bonds. So they're registered, they're redeemable. All right, so let's look at our questions based on this tombstone. If settlement is for December 13th, so what I need is the dated date. So we can see on the tombstone, the dated date is the date the bonds start to accrue interest. And we see that the dated date here is December 1st. And so you, the buyer, are going to owe the syndicate as a buyer, the dollar amount of the accrued interest calculated from the dated date up to, but not including settlement. Settlement here is December 13th, and so the answer would be 12 days. Let me get out my boom. 13 or number 12. A client purchasing one or more of these bonds at the time of the offer could anticipate his first payment on. Okay, well, let's go back now and see if these are, J&Js or F&As. Commencing July 1st, paid by check July 1st. So that means they're J&J bonds, and so that means we would expect our first check from these bonds on July 1st. Boom, C. Which of the following is true of the bonds maturing in 2024? And let's go back up and look at the bonds maturing in 2024. They're the last ones there, 2.5%. Priced or yield 3.8. And then let's see what our answer choices are. The interest is subject to federal income taxes. Well, no, we actually have the legal opinion there. The coupon rate is higher than the yield to maturity. Now we can see that that's not the case, right? The coupon is 2.5 and the yield is 3.8. So that's not true. The bonds are being offered initially at a discount. Indeed. Indeed. So the answer is C. All right, 14. The investor acquired, let's get rid of here. The investor acquired 2.5%, 2.5% 2024 bonds. If the bonds were to be called at par in 2015, the investor's effective yield would. Well, again, if we have a bond at a discount and it shows us here that it's going to be yield to maturity 3.8, if we get the call, we're going to get that money a little sooner, right? And so that means we would have a higher yield. And so the answer would be D as in dog. So 14, D is in dog. All right. Use the following to answer question 15. How much would an investor have received in 2024? And so we go over the payable dates and we look at all those things, we add them up. So we're over here. Let me just get out our highlighter. Boom. Right. So we're going to get 50 cents, 40 cents, 40 cents, and 20 cents. And so $1.25, right? Or excuse me, $1.50. I'm doing this dark 30 because I got a busy day. I've been trying to get this out. So if I make a verbal errata, I'll certainly clean it up. And where you go over to payable, right? And dividends are taxed when you receive them. And that's what that's actually getting at is this payable column over here. An investor is in a low tax bracket. So as a test taker, it sounds like no munis for this person. All right, boom, boom, boom. Clean that up. And wishes to invest a moderate sum in an investment that will provide him with some protection from inflation. Well, I kind of like to project the right answer. And I would be thinking tips or common stock or something like that. But let's look at our selection here. We know the muni goes out because it tells us low tax bracket. The money market isn't going to protect you. The Ginnie Mae. So, I don't really like our answer set, but given that answer set, our best answer is B as in boy. The other selections are all debt-based, right? And we need to have some equity. So a roundabout way to get to this idea of stocks would be a better hedge than a debt instrument. An option is quoted at 2.5. A client purchasing 2 contracts would pay. Okay, well, you're paying 250, 250 times 1 contract times 100, or 250 times 2 times 100. That's the multiplier. And so the answer is going to be $500, right? Oh. We don't know if it's a call or a put, but you have a choice and we know your maximum loss. Securities can be sold under Rule 144 if they are owned at least 6 months prior to the sale. Well, assuming they're unregistered, that would be true, right? If this is stock you got directly from the issuer. They are sold in a principal transaction only. I can eliminate two. Buy orders are solicited from potential customers in anticipation of the sale. Well, no, you're not supposed to make it sound like stock coming off restriction is some kind of a good deal of some sort. Current public information regarding the issuing company is made available. Yeah, given this answer set 1 and 4 is our best answer. We should definitely know that Rule 144, the way you comply is by filing Form 144. That form has to be filed at or prior, no later than concurrently is the way to say that, to your sales. It's good for 90 days. You can sell up to 1% of the outstanding shares or the average of the last 4 weeks trading volume, whichever is greater. And then again, if the person received the stock directly from the issuer, there would be a 6-month hold. If they got in the secondary market, there would be not. So 18, the answer is B as in boy. Which of the following statements is true? Which of the following statements is true? A corporation is required to pay a cash dividend. You should definitely know you do not have a right to a dividend unless declared by the board. So A is out. The amount of the dividend paid by a company can have a significant influence on the market price of the stock. Absolutely. That income stream on the stocks acts as a stabilizer. And, again, you don't have a right to a dividend. So if somebody buys the stock for the current yield and they omit the dividend, the stock's going to drop dramatically. If the stock implements a dividend, that might help. So that looks pretty good. Let's see what our other choices are. A growth company would most likely a cash dividend, the stock dividend. No, the opposite. A growth company wouldn't want to be distributing cash because they'd like to keep it to build the business. A stock split and stock dividend are reflected in exactly the same manner on a corporation's balance sheet. Well, no, that's not true because depending on the amount of the stock dividend, it might alter the par. Yeah, kind of a tough one. Given the answers that B is in boy. B is in boy. 20, a client has purchased 15,000 in IBM preferred shares, 15,000 in a money market mutual fund. In addition, he purchased $2,500 in call options. What is the minimum required amount to be deposited in his account for these transactions? Well, the minimum amount, hence that this is margin. So we can lend you 7,500 and you have to put up 7,500. So there's 7,500. You can't borrow money to purchase a mutual fund. So that's 15,000. We're at 22.5. And we're not going to lend you money to buy call options. You're going to have to pay in full for that. So that's another $2,500. And so the answer is C. You definitely know you can't buy new issues on margin. And a mutual fund is continually offering new shares. It's considered new issue 30 days from the effective date. 21. A client has a portfolio predominantly of growth stocks. It is valued currently at 600,000 with of 1.2, a beta 1.2. So the portfolio is 1.2 times more volatile than the market. The S&P 100 index is reported to be 600. What might an investor do to lessen the effects of a possible decline? So if this person was worried about a particular selection in their portfolio, they would buy a put on that particular selection. If what they were worried about was non-systematic risk. Here, it looks like what they're concerned with is systematic risk in the system, the tendency of securities prices to move together. And so since we have a beta 1.2, we shouldn't be struggling with the idea, by the way, potential decline in the hedge here is to purchase the puts. So we should have been able to get this to a 50-50 pretty quickly. And then based on the beta, we're going to have to overweight it, right? And so 10 would have been if I'm not overweighting. So on 21, I'm just going to overweight it. And it's going to be a 1.2 adjustment. So it's going to be, I'm going to buy a little more puts, right? So the answer is B. Advertising related to municipal securities must be approved by which of the following? Well, you should definitely know that advertisements of any type have to be approved by a general securities principal or a municipal securities principal. for your own edification, general securities principle is a series 24, and a municipal securities principle is a series 53. The series 53 is the exam the guru came closest to failing. I said, what can they ask me about a muni bond? I don't know, hubris, right? And then I sent away for a flaky, well, I didn't know at the time, a self-study course, and it was pretty flaky. I go, oh, this is going to be a big deal. Oh my God. I had to use all my test taking tips and tricks, and got the perfect score, passing. Right? Municipal bonds are not typically sold short. Well, one of the disadvantages of selling short a security that has any kind of an income to it is you're going to have to make the lender whole for that, whether it's the interest on the bonds you're shorting or the dividends. Let's see what our answer set says here. Short shares are permitted only on upticks, which do not exist in the bond market. A municipal short may not be covered. Yeah, remember when you short, you got to give back the borrowed security. And there are 50,000 different municipal issuers with over $4 trillion in debt outstanding. And so it's going to be very hard to, make sure you can give back the exact same bond you borrow. So boom. That's what that means in English to say you can't cover the short, is you may not be able to get that same bond back. As I told you, welcome to an alpha exam, right? Boom, boom, the prohibits short sales of a municipal. You should know the SEC has no authority over municipals. Well, I shouldn't say no. There's been recent changes, but for our purposes, test purposes. Well, I say for our purposes, test purposes. As they had that, maybe outside of our time together, maybe things might be a little different in the real world. All right, questions 24 through 27 are based on the Cape May barge and towing tombstone advertisement, new issue. So here it's $3.5 million that we're raising. It's 11% convertible subordinated debenture. Okay, that's important type of bonds. Debenture, remember, means unsecured, full faith and credit. They're promised to pay, basically. March 15, 2020 is when they mature, convertible into common stock at $10.50 per share. That is the conversion price. And copies of the prospectus. All right, well, let's see what they want to know about this thing. The payment of principal and interest on these instruments of indebtedness are secured by, well, this is a debenture. And you should know that debentures are not secured by anything. They're unsecured. They're backed by the promise to pay, the full faith and credit of the company. Right? If the underlying common stock, if there were securities pledged, that would be a different, right? If the barges were pledged, that would be an equipment trust certificate, right? So if there were certain other securities, that'd be a collateral trust bond. So the answer is D. All right, let's see what 25 is. From the advertisement, which of the following is true? From the advertisement, which of the following is true? I'm just cleaning up mine. Investors may redeem the securities anytime prior to following is true, prior to March 15th. In the event, no, that's not true. You don't, unless there's a put for provision, you're not able to redeem early. In the event of a corporate less, these would be junior, absolutely. Right? These are debentures. So B, right? That's the definition of a debenture. On December 3rd, 2002, the debentures trade at 102. The parity price of the common stock is approximately. Okay, so what we need to do here is figure out how many shares we can get. So let's clean up our thing here. Boom, go back up. And it says the conversion price is 10.50, right? So we need to know how many bonds we can get. So 1,000 divide by 10.50 means we're going to get 9.52, something like that. Call it 9.52, 1,020, 952. And we get here, we get a parity of 1075, right? So 26, we take 1,020, we divide by the 95 shares it's convertible into, right? How did I get that? I took 1,000, divide by 1050, and get the answer of 10 3/4. You're going to have to probably do parity at least once. And then remember, the key here is when given the conversion price, you need to establish the conversion ratio. So if I take par, I divide by 1050, that's 95.238 shares. And then I take the current market price of the convertible, 1,020. I divide by the 95 shares and I get 10 3/4. I would be prepared to do parity calculations on your exam. And again, this is an alpha, so it has an odd conversion price. Usually it would be something more like 20 or 25 or 40 or something like that. On December, we did that one. Which of the following are true statements about CMOs? They're taxed only on the state level. They're taxed only on the federal. They are subject to, they're fully taxable. So Roman numeral 3. CMOs have higher risk of prepayment. Well, no, because we're carving it up. And, we may or may not have that depending on what's going on, right? The whole point of carving it up is some people are going to have more risk, prepayment risk, some people are going to have less. And so the answer is C. And you should definitely know that CMOs, collateralized mortgage obligations, are fully taxable. A broker-dealer commits to $500,000 of bonds of a total offering of $5 million in an undivided Western syndicate. So I think as a Western syndicate, this is testable. What goes down stays down. So if you told me you're going to take down 500,000, then that broker dealer is going to eat $500,000. So if they sell 300,000 of the bonds of the total offering, $1 million remains unsold. Well, the $1 million would be meaningful if this was a divided or Eastern syndicate. This is a Western or undivided, very much a test question. So those $200,000 worth of bonds, you see, oh, my bad, I just misread this, undivided. So this is an Eastern syndicate. Well, let me fix that, right? I was on the back side of this question. I said it correctly. 500 of the 5 million is 10% of the deal. Now that I read it again, I see it's a undivided Eastern syndicate where we're jointly and severally responsible based on our percentage participation. 300,000 of the bonds is no longer meaningful. If this was a divided syndicate, the answer would be B. 200,000 would go into inventory. But it's, again, I'm not going to be popular here because I'm going to be on the hook for 10% of the $1 million, which is 100,000. And my friends are going to be upset because those 300,000 are going to be reallocated, right? So I like that one. You're going to get either version, right? This very much on your exam could have been either divided syndicate, which the answer is C, or here undivided Eastern A. So be careful. Which of the not is not included in the competitive syndicate bid? So we're bidding on some bonds from the municipal issuer, and the one who's going to win the underwriting is the one who provides the issuer with the lowest net interest cost. So we've seen the notice of sale and the bond buyer, and now what is not going to be a component of our bid? What's not going to be a component is the dollar price, or excuse me, the reoffering yield, because the issuer doesn't really care about that. What they care about is the overall interest rate they're going to pay on the bonds, the dollar price, and whether they're going to be priced at a premium or a discount, right? They're concerned with what we call the lowest net interest cost. I would consider that to be experimental. I wouldn't worry about that, but I wouldn't worry about the things around that. That's, competitive bids. Syndicates will be formed. The notice of sale would be in the bond buyer. And the one who wins is the one who provides the lowest net interest cost to the issuer. I would also know order priority. Pro golfers don't miss. Pre-sale orders received before we won the underwriting. Group orders or undesignated orders, we're going to split with the syndicate, right? So pro golfers don't miss designated orders where the customer designates a syndicate member for credit. And then always know that member orders always come last. Always come last. All right, let's move on here. While your client's position is long 1R WRJ 120 call at 4 and long 1 WRJ 120 put at 3, and then long 100 shares at 120. So it looks like I got a straddle with the stock, or anyways, the current market price is 120. What is the client's maximum potential loss? Well, the put's going to protect the stock. So basically, I'm going to be out $700, right? If the stock goes to zero, I exercise my put, 120, and so it's going to be $700, right? So kind of a complicated one. Where is my highlighter? There it is. Right. Use the following information. Use the following information. By the way, I'm trying to get this done in a timely fashion. So as you know, Dean didn't drop a T and show that to you. But if you would need any kind of explication on any of these questions, just put it in the comment, and I'm more than happy to provide further explanations. But I'm trying to bring these things in some kind of a timely fashion, right? So anyways, here's a breakpoint schedule. Varies from fund to fund as stipulated in the prospectus. Breakpoints are wonderful. They're a quantity discount. Breakpoint sales are bad. That's where I try and avoid the breakpoint to maximize my commission. The Wyatt Fund has an NAV of $9.15 and an asking price of $10. So that's the 8.5% there. And I would definitely know that's the maximum legal limit on the Investment Company Act of 1940. So here the customer has $30,000 to invest. How many shares of the fund can they buy? This is very much a test scenario, and so we can either recalculate the NAV, or excuse me, the public offering price based on that higher load, right? So the way I'm going to do that is I'm going to take $9.15. I'm going to divide by 1 minus the sales load. And when I do that, I get 9.786. 9.786 is what you would pay based on this 6.5% load, right? So the way I say this when I'm teaching is when given the NAV and the percentage sales charge, can you calculate the public offering price, right? So here we had to recognize we do qualify for that breakpoint. Now we're back in business. So now we take the 30,000. There's no ways to do math, but this is the way I would want you to do it. And we divide by 9.786, and we get the answer, which is 3,065, rounding up 3,066. By the way, rounding won't cause you to miss questions, right? I like that one. Under Reg D, covering the private placement exemption. So this is a safe harbor under 33 that says that we don't have to make a traditional S1 registration statement with the SEC to sell a private placement. There's two versions of this, 506B and 506B, but we should definitely know the accreditation standards. And the accreditation standards are a net worth of $1 million exclusive of your primary residence, or annual income for $200,000 for the last 2 years, with the expectation of that this year. If you're married and filing jointly, $300,000. 1, 2, 3 is a good way to remember that. Million, 200, 300. P.S. And it's been showing up on the test here of late. You as a Series 7 in good standing are also an accredited investor. So they have a question sometimes where they say the rep is kind of new and doesn't make 200,000, and you should definitely know that. Okay, boom, 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 33. Let me clean up our. For which of the following would the net revenue to debt service be applicable? Well, actually more intestable to know that the net revenue pledge would be found in the trust indenture, and the operations and maintenance fund would have priority, but it's for revenue bonds, and the only revenue bond here are hospital bonds. Slugs are state and local government securities used for the escrow account in a pre-refunded bond. TANs are tax anticipation notes, and school district bonds would be GOs. A customer has sold short 100 GM at 70. GM is selling at 81 points on the market, so that's not bueno. I'm hoping to sell high and buy low. The customer has previously placed a buy stop at 83. I think this is a very smart customer, right? They said, let's stop the loss here at 83. GM announces a stock split and an increase in the dividend. The stock starts to move up and the customer decides to cover the short sale and instructs his broker to buy 100 shares of GM in the market. The registered rep would, yeah, if you're going to buy back that stock, we should cancel the buy stop, right? Because we, you know, I've I've done this when I was a practitioner. I forgot to cancel the other side, right? And then I get a report, uh-oh. So yeah, we'd want to cancel the order to make sure that we don't accidentally buy the stock after we've covered the short. So A, right? 35 is an initial transaction. I like this. We should kind of pay attention here. Let me clean up the slide again. Boom. Let's move this up. As an initial transaction, a customer account, you sell short 100 shares at 30. The market price falls to 25. What is the equity in the account? Now, what you should have known here is that we have a minimum requirement of 2,000, right? So it's going to be 3,000 from selling the stock you don't own, but then you're going to have to put up 2,000. So you're going to have a credit register of 5,000. So now the stock goes to, by the way, in short market value of 30. The market price goes to 25, so that's good. So now we have $2,500 in equity, right? Because we just made $500 from the stock going down. You should definitely know, I'm not too worried about this question about the thing, but I would know that the minimum in a new account is 2, right? So I'm going to get 3,000 from selling the stock. I don't own half of that's 1,500, but I got to have 2. So that's going to be a credit register of 5. I owe stock worth 30, so that's 2,000 equity. Stock goes down, 5,000 minus 25, 36. A client bought 100 XYZ at 65 per share and shorted an XYZ call at 8, closing the short call at 10 and selling the XYZ at 68. What would be the profit or loss? Okay, well, let's see. I bought the stock at 65. I sold it at 68. There's a $300 gain. And then I sold the call at 8 and I bought it back at 2. So that's a $200 loss. I net those two and the answer is B. I kind of like the closing transactions here. A lot of people struggle with closing transactions, right? So opening purchase at 65, closing sale at 68, opening sale at 8, closing purchase at 10. Questions? Let's clear up our thing here. Let's clean up our. Here's question 37, 38 are based on the information from the S&P dividend book. Let's see, the investor bought 100 shares on June 9th and sold it on October 15th, the investor. So June 9th is the X date. That's the first date on which the stock no longer trades with the dividend attached. If the stock were purchased cash settlement, well, then it would settle same day. So yeah, that would be the only way that you would be on the record date in time based on this scenario, right? Let's see. To receive the Atna quarterly dividend declared November 16th. So boom, you have to be on the shareholder list on December 6th. And to be on the shareholder list, you're going to have to buy it the day before the X, right? They love to put you on the timeline and then ask you about these kind of scenarios. And so the answer to 38 would be C, right? We'd have to be on there before on the record date. So the C. Whoop. By the way, transfer agents, what we're doing, this is an alpha. That's just the record date of what they're asking about there. So again, welcome to the alpha. The official notice of sale. So I would definitely know about the notice of sale published in the bond buyer. Shows the following: Polk County, Florida, GOs, issue size 14 million, dated date January 1st, 1995. That's when it accrues interest. The number of bond years. Well, this is certainly experimental, right? So we're just hoping when you get one of these experimental questions, you freak out. But well, the way we would do this, if we would take the 4,000 times here, it says the number of bond years, figure out how many bonds that is, right? And then times it, and then again, 4 million how many bonds by, 4,000 bonds, 5,000. And then we would see the maturity dates, 4, 5, and 6 years. And again, this is experimental, so I wouldn't worry about it. Just try to freak you out. That's part of an alpha where you go, oh my God, so that's it. I told you I'd cut you some slack on this alpha exam and perhaps tell you which are experimental, because God knows I don't want you to go down some rabbit hole on bond years, right? It's not testable. With respect to discretionary accounts carried by a municipal securities dealer, which of the following are true? The account must be expected in writing by a municipal securities principal or general securities principal, but indeed that is true. All transactions, discretionary transactions, must be promptly reviewed by a principal. That's true. Activity must be reviewed at frequent intervals. That too is true. The securities cannot be hypothecated. No, will lend your money against your muni bond portfolio. So the answer is C. Can you hypothecate? Hypothecate, remember, is the fancy word for pledging as collateral. And you can certainly pledge munis as collateral. In fact, that's pretty good collateral. Munis are considered to be the second safest form of credit. All right, looks like we got another here, tombstone, it looks like. Boom, boom, boom. This announcement is neither an offer to sell nor a solicitation to buy the following securities. The offering is made by a copy of the prospectus. So we're seeing here 300,000 shares of Maine Public Service and Light. It's a preferred stock. It's cumulative, meaning if it goes into arrears, they have to make it good. 100 par, priced at 99.35, plus accrued dividends, if any, from July 14th. Copies of the prospectus. All right. So this offering, we should definitely know, is a primary offering, right? Tombstones are used in primary offerings. So 41 is C. To purchase 1,000 shares, 1,000 shares in the offering in a special margin account. Well, there's no such thing as a special margin account. Here in the alpha, we're trying to make you think, well, maybe there's something I don't know about margin accounts. You have to pay in full, right? We don't lend you money to buy new issues. It's considered new issue 30 days from the effective date, so you're going to have to pay in full. So 1,000 shares at that price. So 41 is C and 42 is A. A treasury bond is quoted in the Wall Street Journal as follows. The nominal yield of bond A. So we will assume that bond A is the one we have in the exhibit there as Roman numeral 1. And it looks like it's trading, don't you love this, at a slight premium, and that's the key. Based on our teeter-totter or seesaw, we should know that if it's trading at a premium, the nominal yield of bond A, let's see, is a premium bond, and therefore the nominal yield or coupon rate must be higher, right? Boom, boom, boom. And so again, on the 43, it's a premium bond, and therefore the nominal or coupon rate must be higher. If the value of the US dollar increases against other currencies, it would make. So I kind of like when the dollar's up because I'm a US importer, right? I like to import, Swiss watches and tequila from my friends in Mexico and scotch from my friends in the UK. So that would be good for me, right? This more often than not is going to be a hedging question. But the answer is US exports become more competitive now, right? US exports become less competitive because our US exporters like Boeing and Caterpillar and are going to, have to charge more in the foreign currency to get the same US dollars coming back. So one is not true. US exports are less competitive. Yeah, I just told you why, right? Foreign imports are more competitive. Yeah, my dollar's buying me more tequila, more Swiss watches, more scotch. So it's 2 and 3. A registered rep marked the order ticket unsolicited when in fact it was solicited. Ooh, this is a big, big no-no to mismark order tickets, right? I say, I'm your supervisor. What are you doing? So, I'm trying to protect us later on by marking it unsolicited instead of solicit. Well, don't do us any favor. That is a big, big no-no. All right, here's a balance sheet for the next two questions. The net working capital. Well, working capital, we should know, is current assets, 15 million, minus current liabilities, 3 million. And so the working capital is 12 million. The quick ratio or acid test ratio. So what we're going to do here is take out the inventory. So we have current assets of 15 million, 10 of that is inventory. So 15 minus 10, 5 million. And then we're going to divide by the current liabilities, and that is 3 million, right? And then when we do that math, the quick ratio is going to be whatever that ends up being, which is divide by 3, and we find out on our calculator. Let me just do it. We got current assets of 15, inventory 10, so 5 million divide by 3 million, and that's going to equal choice D. And what that means is we have $1.66 in quick assets for every dollar we owe. Pretty good. A customer without giving written authorization may permit a registered rep to exercise his judgment in which two of the following. Very, very testable. We do not deem discretionary authority to make decisions about time and price, right? So we're going to make a decision about action, whether to buy or sell, asset, which security to buy or sell, or the amount, quantity. Then we need discretionary authority. Very much a test question. Customer buys one ABC October 70 call at 7 and March 10th and sells it for 3. So it looks like I have a $400 loss. And let's see, capital loss of $400. There we go. Choice A. Right. I did an opening purchase at 7. I did a closing sale at 3. That's a loss of $400. A customer buys one ARL October 150 put at 7. Okay. The holder exercises the option in October of the same year when it's at 140. So what I've exercised is my choice to sell the stock at 140. For tax purposes, the sales proceeds are, well, remember the sales proceeds are actually going to be, 143, right? My 150 put I bought for 7, that's 143, right? And then I sold the stock at 140. So my sales proceeds is 14.3. How'd I get the 14.3? What I did there was I said, okay, the proceeds are 14.3 because of the $700 premium, right? That was my choice to sell at 150. So I sold it for 15 grand, less the 7, that's 14.3. A customer buys one Oxy October 50 call at 3. The holder exercises the option when the stock is trading at 6. What is the cost basis on the 100 shares? For the most part, cost basis follows break even, right? So here my break even is 53. So I paid 300 for the option, 5,000 for the stock. And so my cost basis is 5,300. Please note, I think it's more of a test prep vendor issue, but if you look on the channel, I have entire practice sets, with taxation and options and tutoring replays on tax consequences of options. So lots of stuff for you there. An accumulation unit is the share in the separate account during the accumulation phase. So to say I have 6,000 accumulation units is very similar to saying I have 6,000 shares. Once you annuitize them, we turn the accumulation units into what are called annuity units. All right, so let's see what our choices are. Accounting measure used to owners into the, well, there we go. I kind of gave it away before we looked at the answer set, right? The B would have been the annuity units, right? With respect, let me clean up here. With respect to municipal discretionary accounts, with respect to municipal discretionary accounts. One, a municipal securities principal must approve all transactions of the account promptly. That's true. All activity in the account must be reviewed at frequent intervals. That's true. The broker-dealer can affect transactions which has a control relationship. By the way, that is true. Remember, you can't exercise discretionary authority when there's a control relationship. In municipalities, what it would mean is like our CEO sits on the city council. It's the same rule, by the way, for FINRA. And the best example here would be Merrill Lynch, right? I'm a Merrill Lynch broker. I have discretionary authority. I say, hey, listen, yeah, have you been following all the great things Brian Monahan, our CEO, is doing at our holding company, Bank of America? I think you should buy that. And he said, well, Dean, you have discretionary authority on my account. I don't know why you're bothering me. I said, well, I can't exercise my discretionary authority when there's a control relationship. And so here the answer is a C. Let's look at 4. In order to affect transactions when there's a control relationship, no, we don't have to get rid of the customer or terminate that relationship. I don't know how we would even terminate the relationship. I guess on the municipal front, you could resign from the board or the city council. But this is 1, 2, and 3. The big takeaway is no, you can't use discretionary authority when there is a control relationship. Let's clear up our thing. The market value of Honeywell is 105. Your customer buys a March 100, call it 10, and sells a March 2020, call it 2. So same option, call, different action, buy, sell, soda. So we can identify this as a spread. He has no other position in his account. Reg T is 50% of the market value. Well, we don't lend you money to buy options. So this is a debit spread. So as a margin clerk, I say, listen, I need $800 from you, right? It's a debit call spread. And so you got to pay for it. Just for your own edification, if it was a credit spread, I'd make it as a margin clerk, I'd make it put up the loss. What is the maximum profit on the combined position? So this is a debit spread. The gain and the loss always equals the difference in the strikes. So there's 20 points there, right? And then I spent of the 20 points 8, so I can make 12. If you get good, you could say, okay, well, if I buy the stock at 100, which I have a choice to do, and I sell at 120, I'd make 20 points. I spent 8 to get rolling. All the action in a spread takes place between the strikes, right? There's a floor at 100 and a ceiling at 120. And so the maximum gain is $1,200. Prior to affecting, now let's clean up our. Prior to affecting transactions in a penny stocks are very testable, right? So, penny stock is a non-NASDAQ OTC stock under $5. Must confirm whether the person is an established customer. They had funds with us for a year, done 3 trades. Yeah, it sounds pretty reasonable. Must obtain a signed risk disclosure if not an established client. That's definitely true. Must obtain from the client a signed penny stock transaction that you understand you're buying a speculative low price security. Absolutely. Must determine suitability always. So 1, 2, 3, and 4. 1, 2, 3, and 4. A customer purchases a 110 XYZ September 350 put at 4.5. At what price would the customer break even? We'll put down strike price minus premium. So the answer is C. And this is bearish, so I'd want the stock to be below that. Here, it's an alpha, and so they're trying to get you wound up on the 110, right? It doesn't matter. Break even is a per share expressed per share. Which, as long as not a type of sharing arrangement, functional allocation certainly is. Disproportionate sharing certainly is. Reversionary working interest certainly is. And so the answer is D. Again, this is what, we're on question 58. We've been at it about an hour. And I think this is the first partnership question we've encountered. Don't overdose on partnership questions. Two or three of them pretty straightforward, GP, LPs, and the various types of programs we have. So don't overdose on those. Your client is long 100 shares at 50 and long 5 ABC 50 calls at 2. He wants to pay with XYZ stock, which is marginal. So he'd rather give us collateral than he would like to give us money. How many shares would he have to deliver to meet the margin call? The stock that he wants to give us is $20 a share. All right, so he's going to owe us 50% of the $5,000. That's $2,500. He's going to owe us $1,000 for the options, right? So that's going to be $1,000 there plus the 2,500. That's 3,500. And then it says 3,500 is going to be the margin call. We're going to need twice that in securities. So we're going to need $7,000, and then we're going to take the $7,000 we need, divide by the $20 worth of collateral per share. And when we do all that, we come up with C. We're going to need 350 shares of that. And again, this is an alpha exam, right? So we say, okay, I need $2,500, right? For the stock, half of 5,000. We need to pay for the calls. That's 1,000. So that's 3,500, right? 3,500. If you want to pay in cash, that's what I'd ask you for, but it's always twice in stock. That's 7. So 7, and then we divide by the 20. A principal of a municipal securities firm who has the responsibility of supervising muni securities representatives would do which of the following? Review an RR's correspondence. Yes. Approve the opening of a new account. Yes. Write all sales material. All? Oh my goodness. No. Right? Approve each, yeah, it's 1, 2, and 4. No, they're not going to write all sales thing. You be careful of the RTFQ on those little ones that have a little key word there or something that if you miss, it'd be very easy to kind of be going too fast on this one and miss it. 60, the answer is D, 1, 2, and 4. A customer purchasing a new issue of municipal securities, the underwriting was negotiated, must be informed of all the following except the location of the official statement if it's not available for public inspection. No. The underwriting spread, absolutely. The initial offering price, absolutely. And then any fees received from the issuer as an agent, absolutely. So the answer is A. Questions 62 and 63 are based on the following information. An investor who purchased, let's see, last year a certain mutual fund paid dividends of $1.50. 9 months before the distribution, there was 80 cents in capital gains that were paid. The fund has a bid price of $13.50 NAV and an ask price of $14.20 public offering price. 62, an investor who purchased the shares in this fund 9 months before the distribution received $100 in eligible dividend income and $53 in capital gains. This is the individual only investment. The person will not be required to pay any federal income. You should definitely have thrown that out. You should definitely know you got to pay taxes, right? So 1 is out, so that means we're taking 2. Let's see what 2 says. Be required to pay federal on the ordinary income of the dividend. Yeah, you owe tax on the dividends. Yeah, whether or not you reinvest them, you're still going to owe taxes on them. Be required to pay, yep, you owe taxes on the capital gains. One of the disadvantages of mutual funds is you give up, tax control of your investments. So, you're not deciding when to realize tax consequences. The answer is 2 and 3. What is the fund's yield? Very important. You're not allowed to use the capital gains to calculate current yield. That would be the fund's total return. And it'd be unethical to be using total return. I say, hey, we were fortunate to get a capital gains distribution. We may or may not get that in the future. So what we do is what the investment pays us 150 divided by what it would cost us, in this case, 1420. And when we do that math, we come up with C. That would be the current yield. What the investment pays is by what it costs us. Another way to do it is AMP, annual interest or annual dividend, in this case, dividend divided by market price, the MP market price. Which of the following, let's get rid of that. Which of the following would offset or reduce or eliminate a long position? You should definitely know that three things can happen to an option contract. It can be traded, it can be exercised, it can expire, right? Oh, bad answer here. It says a long position, so that would be a closing sale. This answer set is very important. You need to know the ways we trade options. We do opening purchase to establish long positions, opening sales to establish short positions. The reason it's important is because on the test, they'll say several weeks later, and they'll say you offset. You do, and the offset for a long would be a closing sale, and the offset for a short would be closing purchase. The Federal Reserve Board is responsible for all of the following except acting as an agent for the United States, yeah. Conducting monetary policy, yeah. Setting prime, absolutely not. Remember, prime rate is set by commercial banks to their best customers. And according to money supply, yeah, remember they have two mandates of the Fed, two missions: price stability, price equilibrium, and full employment. An issuer's proportionate share of the debt of other local governmental units in which the issuer is located either wholly or partly within the geographical limits of the other units is best defined as, don't you love that? Welcome to an alpha. This would be a city which is 100% coterminous with a county. And so that city would be responsible. The way I say this is when two or more taxing agencies share some of the same geographic boundaries and are able to issue debt separately, right? So that's what that's about. The school district might be coterminous. I am coming to you from Uvalde County. I can't even say it properly, but in Seligman, Arizona, that's a political subdivision of that county, right? And the school district would be a subdivision of that. Boom, boom, boom. Your client purchased 10 HON 50 calls in an open margin account. Well, okay. Honeywell is currently trading at 55. Your client exercises the option. So that means he exercising his choice to buy 1,000 shares. Each contract, he's got 10 of them, governs 100 shares. He has a $6,000 free credit balance. That's just money laying around. What would be the margin call? So I'm a margin clerk. I say, okay, 50,000, and that's going to be 25 grand, but there's 6 already in your account. So why don't you send me $19,000? We'll call it a day, right? How am I getting that? The exercise is 10 contracts. That's 50,000. Doesn't matter. It's trading at 55, right? And then half of that's 25 grand, and he's got cash in the account of 6. By the way, if he has that free credit balance, we have to tell him every quarter he has a free credit balance available to him on demand. Okay, now we got to do a mark to market. How much SMA would there be? Okay, so let's see. He has $55,000 in long market value. He owes the brokerage firm $25,000. So he has $30,000 in equity. We always want to see if perhaps we can't loan him more money. And so the way we decide that is we take half of that would be your SMA, which is right. So 5,000, half that's 2,500. Your client writes 20 ABC November 220 calls at 5. Wow. So, I have an obligation here to buy 2,000 shares. That's crazy. This is really silly. This is a naked call. In addition, he bought 2,000. Oh, there we go. The smart guy. So now he has a covered call because he just bought the stock. So what is the break even on this? Well, we paid out 220 for the stock. We brought in 5 points for the option. So we're net out of pocket 215. Right? So when we have a buy sell, we net those two numbers, right? So remember, break even is based per share. I like here in the alpha exam, we give you a choice of 225. If this was just a speculative basic option position, that would be true, but it's a covered call, right? So we are lowering our out-of-pocket cost from 220 on the stock, less the 5, 215. Which of the following is not a valid use of the partnership democracy? Well, in my career, we have had to toss out a general partner by a partnership vote. The partners have met and you are no longer the general partner, right? So deciding which partnership assets should be liquidated to pay creditors, no, that doesn't sound like a use of the partnership democracy. Yeah, removing the general partner, right? The partners vote and say, hey, you've been removed. Consenting the action of the general partner that is contrary, yeah, right? So that we take a vote. Consenting to a legal judgment. Consent means vote. So given this answer set, it is A. Was that our second partnership question in this alpha exam? Which of the following is true of index options? You definitely know that index options settle in cash. If I received an assignment on a short index option contract, I had to deliver 100 shares of 500 stocks, for example, nobody would play with you. And so they settle in cash. You should definitely know that. Very testable. When an index option is exercised, the amount in the money, yep, that's true too, right? Let's look at 3. The maximum risk is the dollar value of the strike less the premium. No, which is like, other option contracts. When index of settlement is 2 business day, no, it's T plus 1. So 1 and 2. Roman number 1 is very testable. 72. An investor believes that interest rates will fall in the near future. If the investor wanted to profit from this belief, which of the following actions would he take? This one is, remember, you think interest rates are going down, that means you think bonds are going up. However, we now have what are called yield-based options, which have a direct relationship. So I wouldn't worry about 72. We're going to get rid of 72 as a testable issue, but you should definitely know that inverse relationship. And then you should now know that we have yield-based options that have a direct relationship. So you would buy puts, a yield-based put. If the IRS makes a judgment that a tax shelter was abusive, in other words, you had too much tax benefits and not enough economics, the deductions are disallowed, yep. You're charged interest, and yeah, they may charge you with the intent to defraud. So 1, 2, and 3. So you can't let the tax tail wag the investment dog, right? You should make the investment based on the economics potential for profit. And then those would be, advantages, I guess, tax flow through if you didn't have some losses. The PR at 102, bonds are, what does that mean? That means they're pre-refunded at a dollar price in excess of par. The answer is D, right? Boom. I wouldn't worry about 74. Yeah, this is about the blue list, which nobody anymore actually uses, but the blue list is where we would typically find bonds for sale on a secondary basis. So again, this would be an experimental question. I wouldn't worry about this one at all. 75, very, very testable. You should definitely know that Ginnie Mae has the full faith and credit of the United States government, the U.S. Treasury. So the answer to 75 is D, very testable. The advantages of owning a real estate direct participation program, aka also known as a partnership, include all the following except. Well, you should know that depletion is for a natural wasting resource like oil and gas, and real estate is not a natural wasting resource. We certainly get cash flow in real estate. We certainly can depreciate over the useful life, particularly commercial real estate, and we get the upside, right? 77. Under the New York Stock Exchange special block procedures, Which of the following appear on the tape? Well, all these would appear on the tape, right? I always think of a legendary block trade that took place in the securities industry was a 10 million share block of Disney, and that was a block, right? And Goldman Sachs was handling the block. Special bidder offer, yeah. Exchange acquisition, exchange distribution. I wouldn't worry about this except to know that, it may not, the New York Stock Exchange, this is very testable, is a auction order driven market. And so, it wouldn't be prudent of me to go into the crowd, the auction, 10 million shares of Disney, all the buyers would disappear, right? So we're going to do the block trade off the floor and then report it to the tape. A limited partnership for federal income tax purposes is considered by the IRS to be, yeah, remember there's a flow through. And so partnerships don't pay taxes. They send the distributions and K1s to the limited partners. The one I always use is the Golden State Warriors, right? It's a limited partnership, right? So the consequences, the economic consequences flow through. So that's what this is getting at. What it's getting at, I think, is very testable. But again, it's an alpha, so the wording is a little more challenging than it otherwise would be. The Investment Company Act of 1940 requires that mutual funds pay dividends from their, I like this one, right, from their net income. We don't want mutual funds misrepresenting capital gains, right? They must pass through at least 90% of that net investment income. The dividends on the stocks in the portfolio, plus the interest on the bonds in the portfolio, less the expenses. Crossover, in partnerships, we have tax advantages. For example, depreciation. And crossover point is where we no longer have those tax advantages available to us, right? And so, not, if I'm the general partner, I said we've crossed over. That means we've, got a point now. Well, I shouldn't say not good. I mean, again, I get to stay out of trouble with the tax dog tail wagging the investment dog. But here's what I'm saying to you as a general partner: our cash flow falls short of net taxable income, and deductions are already exhausted, which means we're now realizing tax consequences to that income. Legal opinions, very testable. Which of the following describes an unqualified legal opinion? Where unqualified is great. That means I don't have any reservations about the legislative authority as a bond counsel. I'm opining that they have the legislative authority to borrow the money, that the interest is federally tax exempt, and that they don't need to give you make a registration statement and give you a prospectus, right? So it's actually D. It's a good thing, right? It's a good thing. A municipal bond is purchased at a discount in the secondary market at 90, so that's 900. The face amount is 10,000. The bond has 10 years to maturity. So the bond is sold for 97 after 5 years. So what is the taxable gain? So if the bond was purchased for 900 and we sold it for 97, there's 10 of them, it looks like we're going to have a $700 capital gain. What this is getting at is that there is no tax advantages to buying a muni bond and selling it low and selling a muni bond high. It's just like buying a stock. There's a taxable gain involved, right? The only component of a muni bond that is tax-free is the coupon. So the answer to 82 is A. Now, by the way, this isn't an OID. It's just something I bought in the secondary market. And the point about that is, remember, to make you think it's a primary transaction, and then we would accrete, but it's not an OID, and therefore we don't have to accrete. 83, a conservative client is interested in purchasing a life annuity, 20-year period certain. He would consult which of the following to determine the safety of the annuity. In other words, can they make good on the payments they promised you? And the rating agency for insurance companies is AM Best. Which of the following would be found in a municipal revenue bond resolution? Right. So remember, the resolutions would be found in the trust indenture. Requirement to public, yep, the books and reporting requirements, yeah. The maintenance covenant, absolutely. The terms of the rate covenant, absolutely. So the answer to A4 is D. All of those would be found in the trust indenture. I told you the big one is to know that the rate covenant or the revenue pledge, net revenue or gross revenue would be found in there. So D, 1, 2, 3, and 4. 85, very testable. What gives the customer the largest monthly payment? If he annuitizes, it's when he says life only, life annuity. That's very much a test question. The FOMC would purchase treasury bonds, so they would expand the money supply, right? When they buy the securities, the money supply goes up and interest rates go down. And usually when the Fed is lowering interest rates, loosening, loose monetary policy, they're doing so because they're afraid of the economy, right? So all the following except. Uh, so the S would be purchase. So they're purchasing the securities. So, oh, my bad, right? They're purchasing the securities. The securities are coming out, the money goes out, right? So the answer here is D. The unemployment would be the economy doing well. So, the consumer price index, bond ratings, GDP, they enlarge the money supply when they're vigorous. So it says decline. So decline in CPI, bad news. Decline in credit quality, bad news. GPT, decline. So those are all bad things. A decline in unemployment is a healthy thing. So that would be I call this the Sesame Street trick. One of these things is not like the other. The X dividend date. X is the dividend. X means without. So the X dividend date is the first date on which it no longer trades with the dividend test. There is no secondary trading in a open-end mutual fund, right? So it applies to current transactions only. No, does not apply to dividends. Or no, it's set by the fund management. Yeah, there is no secondary trading. So, in secondary trading, it's a function of the Uniform Practice Code, but there is no secondary trading as it relates to mutual funds. Which of the following activities would be in violation of industry established guidelines? So let's see. Inducing, the minute you hear inducing, that's bad. Inducing a customer to purchase securities and slightly below level, well, that's called a breakpoint sale. You shouldn't be struggling. That is definitely unethical, bad. Failing to effect transactions at quota price without identifying nominal. Nominal means for informational purposes only. I didn't tell you it's nominal, so you expect I would honor the quote. If not, it would be backing away. So we need 1 and 2. Let's see what are our other choices here. That's the only answer set that works. Selling exempted securities aligned with it. Now that's called a repo. That happens all the time, particularly on exempt securities, treasuries. Exchanging customer securities, collateralizing the debit balance, and pledging other securities. Now that's rehypothecation. A, 1 and 2. What type of economic theory calls for cheap money policy and an increase of government activity as a method to stimulate the economy? Well, that's Lord John Maynard Keynes. He said we should use government to stimulate demand. It looks like we got another tombstone. So $40 million, General Telephone Company of Alaska. These are first mortgage bonds, so they're secured by real property. 9% due 2042, priced at a slight discount. All right, let's see what they want to know about these questions. An investor who bought one of these bonds, well, interest payments, oh my God, angels weep for you if you miss this. 9% based on par, that's $90. Listen, as an alpha test goes, that's about as easy as you're going to get on an alpha test or on a actual test. So the 90 is C. The state of Alaska has an income tax for residents. An investor residing in Alaska who purchased these bonds would find the interest received. You should know that all bonds would be exempt from federal income tax. And to give you an incentive to invest locally, the state of Alaska says, hey, we won't charge you income tax either, right? So the answer to 91 would be 1 and 3, which is choice, let's see, A, right? We should definitely know that, right? Reciprocity doesn't apply state to state. So, if Alaska has an income tax and you buy a Washington state bond, they're going to tax you on it. So 1 and 3. 92, a broker dealer commits to $500,000 of bonds. Oh, here we go. Earlier we had an undivided Eastern syndicate where our liability was based on proportionate or percentage participation. Here it says divided syndicate, also known as a Western syndicate. And I like this. So now it's not that it's 10%, right? So now it's 300,000. What happens to the other 200,000? They go up to bond heaven with the puppies, where puppies go? No, no. They go into inventory, right? Attention brokers, blue light specials. So 92, the answer is B. Your client wants to purchase a 90, call it 7, and short a 95, call it 2. What would you inform the client? I'd say, well, listen, Mr. Jones here, you have a choice to buy at 90 and an obligation to sell at 95, and you paid 5. This is an alligator spread. It's going to eat you alive, right? It looks like it has no economics to it, right? Because it's a debit call spread of 5, and the difference in the strikes is 5. Yeah, so we should recognize that's an uneconomical trade. 93 is D. Good one. A registered rep must obtain written verification of a customer's net worth for which of the following? Well, remember, it's most likely, that the direct participation program would be the only one of these that would be offered on a private basis, perhaps. And right, that means it's a Reg D 506 C, perhaps, a partnership. And in that circumstance, we would want that. By the way, even if it wasn't a private placement, we'd still, because of the lack of liquidity, want to have more information for you about A, right? So the answer is A. A company has net sales of 3 million for the year, so that's its top line, its revenue. Its income before taxes is 150, so it's going to have to pay some taxes. The company's equity capitalization, corporations are always capitalized with common stock and perhaps other things, but common stock for sure. 50,000 of 100 preferred with a 6% dividend and common stock. So I don't see any debt here, so we've capitalized this with equity. That preferred stock has preferential treatment and dividends. We get paid dividend to common if we're in arrears and in liquidation. The company is in a 50% tax bracket. What is the company's earnings per share? All right, so what we're going to do here is we're going to take the 150,000. It tells us they're in a 50% tax bracket, so that's going to be 75,000. Then we're going to pay the dividends on the preferred stock, 50,000 shares at 6%. That's going to be 50,000 shares times 0.6. That's 3,000. So now we have $72,000 left over. 72,000 divided by 120,000 shares is 60 cents. Boom. Right. So how did I do that? $150,000, and then we pay our taxes 50%, 75,000. So we got 75,000 left over. We pay 6% on 50,000 shares. That's another 3,000. So we have 72,000 left over. And then 72,000 divided by 120 is 60 cents. Questions 96 and 97 refer to the financial statement of the corporation ending December 31st, 2000, whatever, right? A balance sheet is a picture in time, right? So balance sheets, income statements. What are the earnings of the common? Let me just get rid of this, move it up. What are the earnings per share? Wow. Okay. So once again here, we're going to say, what are the earnings per share? Operating income net income 22.5, right? And then we're going to minus the preferred stock again, which is 5% of 100. That's going to be $5,000. So then we're going to have 17.5. 22.5 minus paying our preferred stockholders. We have outstanding 5,000 shares. And so again, 22.5 divided by 5,000 is 350. And again, an alpha on the actual test, I don't think you'll get as many balance sheet kind of questions here. Well, now it says if everybody converts, and so we remember we have these convertible debentures here, and those are 20 shares, $20 is the price. So if everybody converts those, what are the fully diluted earnings per share? Well, now we're not going to have to pay the preferred stock, or excuse me, the bonds. So since we don't have to pay the interest on the bonds, more money is going to fall to the bottom line, right? But we're also going to have 5,000 more shareholders out there. So the fully diluted earnings per share, by the way I would have got this right is I just know it's going to be lower because the share count's going up, right? And we're going to have more shares and we're going to save some money on the interest, but that's going to be $2 a share. 50,000 minus 25,000 minus, the 5, we end up with 20, and then 20 divided by 10,000 shares because it's going to be a double of the number of shares outstanding. An example of overlapping debt. Again, this is the second version of our time we've seen this. Remember, it's when two or more taxing agencies share some of the same geographic boundaries and are able to issue debt separately. The term for that overlapping debt is coterminous, living together. And that's what coterminous is about. So the answer here is D. An issuer of municipal securities has prepared an official statement for a current competitive underwriting. Under MSRB rules, municipal securities dealers participating in the underwriting have which of the following obligations? Furnish a copy of the official statement? Absolutely. Promptly furnish on request the official statement to other dealers? Certainly. Disclose to each customer the underwriting spread. Well, typically the underwriting spread would be in the official statement and, depends on the competitive, has prepared for the competitive thing. So 99, the answer is A. And only the negotiated spread would have to be disclosed. I wouldn't worry too much about that one. Let's chalk that one up as experimental. Experimental. Which of the following bonds would not be suitable for a municipal security seeking call protection? So the bond most likely to be called, I like this, the bond most likely to be called is the bond with the highest coupon and the least amount of call protection. So now we just got to figure out what answer says that, right? Outstanding bonds with low interest rates, no. Outstanding bonds with low interest rates, no. Outstanding bonds with high interest rates, ding, 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 ding. And low call programs, ding, 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 ding. They have less call protection in terms of price, right? So call protection consists of time and price, and that price is low, if they call the prepayment penalty, if you will. The interest income received on an industrial bond may be taxable to the holder if, now here, this is just, again, the subject to the AMT, right? And what we're asking about in this question is to recognize which one of these would be a private activity, right? So the AMT kicks in not on earned income in excess of 100. It's more like in the 200,000 range. So the takeaway is to know that private activity bonds, industrial development revenue bonds, are not suitable for investors subject to the AMT. And the IRS calls these private activity bonds. C is just nonsensical. D is nonsensical. A customer goes long a 40 put at 5 and writes a 50 put at 13. So same option, put, different action, buy, sell. This is a credit put spread. This is a credit put spread. We paid out 5. We brought in 13. So we brought in a total of 8. So credit, expire, narrow. Credit has 6 letters. Expire has 6 letters. Narrow has 6 letters. All following occur except. Now we got to be careful. This is an except question, right? An except question. The spread widens. We don't want it. By the way, test taking trick, A and D are exact opposite answers. And so we should know it can't be A and D in the same universe, right? I like to say, there's an example of this test taking trick. Socrates is a dog, Socrates is a philosopher. You can't be both a dog and a philosopher, right? Yeah, expire would be good. We keep $800. That's a good thing. We close out the 40 put at 6 and the 50 put at 1. So the spread was 8. Now the difference is 5. I like this. This is an example of what we mean by widen or narrow, right? When we did the spread means difference. The difference was 8. Now the difference, 6 and 1 is, 6 and 11 is 5, right? So it narrowed from 8 to 5. We're a winner. We're a winner. By the way, I'm not going to, again, we're trying to get this done in a timely fashion, but I set up my T and put 5 out, and then I put 13 in, and then I closed out the 40 put at 6, and I closed out did the offset 11. I could show you how that works. And as I said, if you want to put that in the comment, just say, Dean, could you exploit question 102? And I'm more than happy to do so. Anyways, yeah, we went to narrow, and C is an example of that narrowing. I think it's the hardest part to get. You don't really need to get it because it goes together all the time. All right. All right. Looks like we're coming down the back 9, so to speak. Oh, well, look at that. We get to rock and roll. So I call this don't hate the 8. There's 8 things we got to know about a spread, right? Can we identify, and if you watch my videos, you know all those 8 things. Anyways, the break even here is going to be push, put, subtract from the higher. So our net is 8 from 50. Our break even is 42, and we're bullish. So anywhere above 42, we're going to make money. So the customer will break even or profit all the following except, well, the answer is D, right? The client, okay, it looks like that's the end of that one. A client bought 5 60 calls for 5 and sold the 70 calls for 2. So again, debit call spread. What's the maximum possible loss? Well, be careful here. I'm out 3 points on 5 contracts, right? So you got to be a little careful here about this. So, 5 contracts and I'm out 3, so that's going to be $1,500, right? The client, what's the maximum possible loss? He bought the 60 calls and sold the 70 calls for 2. What would be the client's maximum potential loss? Oh, look at this. Well, I told you the Alpha exempts are pretty tricky. You got to be a little careful here. And so we have 5, but we sold 10. There's no such thing as being, partially naked. So I'm naked on 5 of those calls. I was kind of struggling looking at the answers. I didn't, my spidey sense said something's up here. Let me go back and RTFQ. So, yeah, we got more contracts short than we got long. That's a problem. A municipal syndicate manager for a syndicate that normally bids on offerings up to 50 million wishes to bid on 100 million. Wow. So, we want to, go big or go home. The manager may do all the following. So, how are we going to go from 50 million to 100 million? What might be some good ideas here? Bid on the entire 100 subject to the agreement among syndicate members. So do all the following except subject to the agreement. Okay, let's look at require each member to double its participation. I say to my syndicate members, you got to step up, my friends. Not bid on the issue, withdraw from the bidding process, allow the participants to drop from the syndicate and add new members. Now, this says accept. So might I bid on the entire 100 million with a agreement of my syndicate members? That sounds reasonable. I can't make syndicate members do things if it's not in the syndicate letter. So that looks like the one that's kind of the odd one. Not bid on the issue and withdraw, certainly. Allow the participants, if you're not into it, hey, drop out. Absolutely. The answer is B. B. Your customer owns 100 shares of ABC, which are being held in street name. What procedure will you apply regarding your customer's proxy? right? So, we suggest you put in a street name because it helps us backstage, and a margin account must be in street name. And that means that proxy material is coming to the broker dealer and we have to forward it to you at no charge, right? That's testable. We're going to forward proxy materials. Which of the following are usually true regarding municipal revenue bonds? The issuance of the bonds is dependent on the earnings requirements. Hmm. Yeah, I mean, I think we're going to be concerned with earnings in a revenue bond too. The bonds are backed by the unlimited absolutely not. Right? I mean, that's the whole point. They're not backed by that. That's a GOBA. The bonds are issued based on the concept we'll pay for the project. Yeah, the users are going to pay. That sounds reasonable. Are only suitable. No, that's not true. So the answer here is 1 and 3. B. A customer buys 100 shares at 30 and sells short 200 XYZ at 50 on the same day. The customer then writes 1 ABC 30 call at 5 and 2 XYZ 50 puts at 6. Okay, so what is the Federal Reserve margin requirement? Oh boy, what a mess. All right, so let's go through this. 100 shares at 30 is going to be $1,500 for that. You sell short 200 shares at 50, so that's going to be half of that. So that's 10,000, 5,000. So 1,500 and then 5,000 for the short sale. I'm a margin clerk. You're covered on the October 30 call at 5, right? Because you actually have the stock. So we're going to let you use the 500 as to meet the margin call or the margin requirement, I should say. So that's going to be 500. And then we write 2 XYZ December 50 puts. And you have an obligation to buy there, but you are short the stock and will need to buy to cover. So you're going to be able to use that. So the requirement's going to be 6,500, right? 1,500, 5,000, 6,500. That's the margin requirement. And then it says initial. So now of that, what are you going to have to put up? So you're going to need, you're going to need 6,500. But of the 6,500 you need, there's already in your account 1,700. And so we'll minus that. And you get to use the proceeds from the covered call and the covered put to meet that requirement, right? So half of the 3,000, half of the 10,000, that's 6,500. That's the answer to 108. That's the margin requirement. Margin call is the difference between what you need and you got. Of the 6,500, there's no margin on the call because it's covered, and there's no margin on the put because it's covered. But that is money in the account. That's 500, and that's 600. So that means we get 500 and 1,200, excuse me. So that's going to be 1,700. Again, this is an alpha. This is an alpha. If you made it this far, I don't know, kudos. Yeah, I would be interested in your thoughts on whether Dina ultimately made the right choice to share this with you or not. 110 is dollar cost averaging. Dollar cost averaging is very testable. What makes it work? Fixed dollars invested regularly. What's the end result? Lower average costs than those of the underlying shares. And it doesn't guarantee a profit. So the answer to 1T is C. Boom, uniform amount, constant dollar thing. The uniform amount, fixed dollar amount, right? $500, $200, and maintain inequities regardless of the current. So you're doing exactly what you should be doing, which is buying more shares when they're low and less shares when they're high, right? When must a preliminary official statement be delivered to a customer? Well, preliminary is what we're going to use until we get a final official statement, right? It should be delivered at the time of confirmation if the final official statement is not available from the issuer. 112, the manager will credit each syndicate member based on sales of a particular maturity allowed to that member, and such credits shall extinguish liability based only on such securities is sold by the member. This describes an agreement amongst underwriters that is. So we've got a couple of these questions about this. This is the jargon for a Western syndicate. The manager will credit each syndicate member based on sales of the particular allotment, right? And such credit shall extinguish, there's the key, liability based on such securities are sold by the member. And so this is going to be the jargon that we use for a Western syndicate, also known as a divided syndicate. A new customer comes to a registered rep to sell stock. A customer wishes to sell 500 shares of XYZ at 30, with the instructions that the trade be done privately and not in the open market. The registered rep must do which of the following? Yeah, I'm not sure what this is supposed to mean, but right, and as an agent, he or she must refuse the sale. I don't know what you mean private. What's it mean private? There is no private. It's a public marketplace, right? So kind of you don't do a private transaction between customers. You got to take this to the appropriate market center. A customer is long a Swiss franc put, so he thinks the Swiss franc is going down with a premium of 1.25. How much will the client lose? So again, what they're hoping when they give you a foreign currency option is you freak out. As long as you don't freak out, you're okay. So what you got to figure out is what we paid for the contract. These are expressed in cents per unit. So we move the decimal spot 2 spots to the left, right? So 2 spots is going to be 0.0125. So we take our calculator. I'm moving my decimal spot 2 spots to the left, 0.0125 times the contract size, which is 62,500, and I get 781.25, choice A, right? When syndicates are very large, managers often use Munifax, a private communication system. This service is provided by, who cares? This is one of those things. I would know the bond buyer, not this particular question, but the bond buyer is a newspaper or paper, electronic paper, I shouldn't say now, widely read in the municipal market. The thing we should know about this is that's where we're going to find the notice of sale if the bonds are going to be underwritten on a competitive basis. 116, very testable. Domestic trading of foreign securities. And remember, you have foreign currency risk. Foreign currency risk. 117, a stock is sold on November 30th when the record date is December 1st. Well, we don't really care so much about the record date as we do the X date, right? So let's see, which of the following is true? The seller is entitled to the dividend if the trade is done in the regular way. That is true, right? Because, well, let's see, the seller is entitled to the dividend. We sell it November 30th, it's going to settle. No, the seller's not going to be entitled to the dividend. So it's going to be 2. The seller's not entitled to the seller's entitled to the trade is done for cash. Well, cash settlement, the stock is sold when the record date is. So the seller's not going to be entitled to the dividend. It's 2 and 4. Let's see. It looks like I got a typo. I think this is a question. Let's just get rid of this question. And boom, I'm gonna get rid of it because it's not, looks like I have to, we'll fix that based on our change. This is an exam, alpha exams. I created alpha exams prior to them changing, the settlement date. So let's let that one go. A bond with 25 years to maturity, 7% coupon, quote on a 6.25 basis. That's a fancy word for yield to maturity. Is callable in 10 years at 103, 15 years at 102, 20 years at par. On the customer's confirmation, the dollar price must be quoted. We always show you the nearest call. Whoop, oh, my bad. It looks like I'm using mine. Boom. All right, so the earliest call date has the lowest yield, and that's what rule MSRB rule G12 says, that we have to quote yield to worst. We always quote yield to worst. An investor with a very large salary, woohoo, 2 years from retirement, wishes to shelter a portion of his income Which of the following would provide the substantial initial write-offs? So yeah, the exploratory program, wildcat program. You go, other cats don't go, very risky. But I say, hey, at least if we don't find oil, we can use those passive losses against our passive income. You can't use it against your ordinary income. You can only use it against other partnerships. So passive losses can only be used to offset passive income. An investor wants to do a tax swap. So a tax swap is where I call you and say, hey, interest rates have gone up, your bonds have gone down. Why don't we sell those bonds, take a loss, and buy bonds that are very similar? We don't want to have them identical because then we violate the loss sale rule. Right. So what we're going to do is alter something. We're going to alter the coupon, the maturity, whatever the case may be. And the answer to 120 is A, right? So boom, and tax swap. He originally paid more money if he bought the bonds with shorter maturities, higher coupons, or similar ratings. Perfectly legit. 121, a customer on June 4th purchased one May 96 5.5 Treasury bond at 103. Well, once again, welcome to an alpha exam. This is a Treasury security. Remember, Treasuries use an actual calendar for calculating accrued interest, and they settle T+1. We calculate accrued interest from the last interest payment date, March 15th, up to but not including the settlement date, which in this case is going to be June 5th. Right? So March is going to be 17 days. If this was a corporate bond, it'd be 16, but remember it's 17 because March has got that many days in it, right? 30 days for April, 31 days for May, and then up to but not including settlement, which is going to be 4 days here because settlement's tomorrow. That's going to be 82 days. Now, I wouldn't worry too much. Very, very low probability. Once in a blue moon, somebody said they had to calculate the actual number of days of accrued interest, usually corporate. But I would definitely know accrued interest is paid by the buyer to the seller. The very testable, it's calculated from last interest payment date up to its recognition primarily. I would also know what bonds trade flat, bonds in default trade flat, income or adjustment bonds trade flat, and zeros trade flat. Trading flat means no calculation of accrued interest. So that I would definitely know. Which of the following are considered when determining whether a tax swap of municipal securities will result in a wash sale? Remember, doing a tax swap on bond is a very good thing to do at the end of the year if interest rates have gone up. And so you want to make sure it's not identical. And so what isn't making it not substantially identical would be to alter the coupon, the maturity, or the issuer. The principal amount really doesn't matter. I mean, we probably try and keep it similar, but that's not really what's going to distinguish whether or not you have done a wash sale. So those are the things we actually kind of want to make sure we alter. Which of the following procedures are required when opening an option account? Very testable. The registrar must document the customer received the OCC disclosure document. Absolutely. DATO 15. So the D in DATO 15 is a memory aid device as a disclosure document. The background and financial must be provided by the customer 15 business days after account approval. Yep, DATO 15. If there's a material change in the customer's financial statement, should he let us know so we can amend it? Absolutely. Any recommendations must consider the situation of the customer? Absolutely. So 1, 2, 3, and 4. I can't imagine any draw in which you don't get disclosure of the sequence. Disclosure, account approval, first trade, option agreement back within 15 days. The difference between, let's go down this slide. The difference between excess over par on a municipal bond is called the difference between the excess of par over the dollar amount of a municipal bond. So if par exceeds the market price, boy, welcome to an alpha, right? Excess of par, it's a discount. right? So boy, welcome to alpha tests, right? Right. So if the par exceeds the market price, the difference is called the discount. The following are identified with the FCS. Again, the Federal Home Loan Bank deals with the the savings loan industry that used to exist. This again is just an experimental question. The answer to 125 is A. I wouldn't worry about that one at all. So as I told you, the 5 experimental questions, we're just trying to freak you out with things you've never seen, like bond years, and never will see, like bond years. Question like this, what you never see. And again, on your actual exam, you got to take these kind of questions in stride, where you go, well, I guess that's an experimental question. I'll, guess B is sign of the universe, and I will move on. Right. So here is again another tombstone. It's a federal farm credit banks. The farm credit system is to provide liquidity so banks can continue to make farm loans, which are required to be given in a municipal new issue. Let's see. I'm seeing where this goes to. Oh, there we go. I guess it went to that previous question. 126. The answer is A. Confirmation of the purchase price in the official statement would be that we don't, give the other information isn't pertinent, I would say, right? And the agreement amongst the underwriters between us, it's 1 and 2. And remember, the more important part about this new issue is on the when issued confirm. I'm going to show you the dated date. When issued, because we haven't issued the bond yet. So we're going to have a when issued confirm. And on the when issued confirm, since I don't know settlement, I can't actually tell you in total what you owe for this new issue. Because besides the price, you, the buyer, are going to owe the syndicate the dollar amount of the accrued interest from the dated date up to, but not including settlement. While syndicate is open, we don't have that available. So 1 and 2. Boom, boom, boom. A client writes 520 M&O 20 straddles, receiving premiums of 3,500. At expiration, M&O is trading at 29. He's exercised on his short calls. The client has A. Well, the answer is he's got a problem, right? Right. So if he's exercised, he has to buy the stock at 29 and sell it for 20. So that's a $900 loss on 5 contracts, which will be offset by the $3,500 in income he got from writing the straddles. So he ends up with a $1,000 loss. All the following apply to a unit investment trust except, unit of trust are not managed. The assets are professionally selected. This is very much a test question, but they're not managed. They're not actively managed. It's again low probability, but it's certainly on the test. To determine the winning bid on a net interest, lowest net interest cost basis, an issuer will, the answer here is subtract any premium, because if we sell the bonds at a premium, that will reduce your interest cost, right? If we can get more than par. And then if we sell them for less than that and you got to pay par, that's going to add to the cost of the issuer. So it's 2 and 3. A customer thinks the Swiss franc will depreciate against the US. I like these kind of questions because they're hoping you're going to freak out that this is a foreign currency. It doesn't matter. It's just like if we were betting on a company. In terms of betting on a country, the Swiss francs is a proxy for the country, right? So you think the Swiss franc is going to depreciate against the US, so you're bearish on the Swiss franc. So you're looking for a bearish option strategy, right? That would be appropriate to take advantage of this. A credit put spread is bullish. Uncovered call writing. Uncovered call writing, that's bearish. I'm looking for bearish. I'm not probably the best thing to do, but it's bearish. Debit call spread is bullish. Uncovered put writing is bullish. So the only thing there that is bearish is the short calls on the franc. Now, don't overthink it. I mean, I think that would be silly, but oh well. Okay, so I don't know how you did on that. Let me know your thoughts on whether it was productive or not productive. I mean, this is an alpha. And remember, unlike the actual exam, which gives you a balance of easy and difficult questions, alpha exams, practice tests like this only give you the most difficult questions and concepts you could expect to see. So do not be alarmed if you struggled on this exam. I wouldn't use this exam as a diagnostic. We have plenty of diagnostic practice tests in the playlist for you. And again, if you have any question you'd like me to talk further about, just put in the comments. I'm more than happy to do a full explication video on it. I'm trying to bring these in a timely fashion, and it looks like I brought this in another a couple hours. I appreciate all the time you spend with me on the channel. And remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. And I will see you whenever I see you for the next explication request.